I hope everybody is ready for the month of May. May is typically a very unique month in the business because it's sort of like that, well, June's the last, but it's almost like the last month to purchase homes, to put contracts in, that is, if you want to get in before school starts. Now you can stretch that into the month of June, but May usually gets kind of robust, largely because people that are saying, I got to get my kids registered for school, they start the beginning of August, I got to get something done so that I can get them in. So May through about the second week of June, it gets kind of robust all of a sudden. And I'm not, and then everybody just got done with spring break, so we'll be curious to see what happens over the next 6, maybe 7 weeks or so. But what I'm going to concentrate on this morning, something I mentioned at Connect on Wednesday, and I want to chat about a little bit more because it's such a big deal today, and that's credit. Credit. I don't like using the words credit repair because that's really frowned upon by the regulators. So I'm going to call it credit improvement. But first I want to start with the fact that there are huge changes that are coming in that industry. Now, there are actually companies that say that they can help get your credit better. The biggest company in the industry was a company, and some of you may have heard of it, you may have had clients go to a company called Lexington Law. Anybody hear of Lexington Law in the past? No. All right, interesting. They've got 2 other subsidiaries, and Lexington Law was just fined almost $1 billion for practices that were misleading to the public. One of their largest subsidiaries is actually shut down. Well, that sent a ripple through the industry that's in that industry because there are certain requirements that they're supposed to meet that now are going to be in question, and nobody wants to be fined tens of millions or hundreds of millions of dollars like Lexington Law was. So there are some big changes coming. Now for the last 10 years, I have personally been referring people to a company in Colorado called Continental Credit. And when all of this took place, they just got bought because they don't want to be under the scrutiny. I think they've done things pretty well, but that industry is going through a tough time. One of the issues with that industry is that you cannot promise someone that you can get their credit score up and charge them. In other words, all these companies would charge you something up front, and then you'd either sign a contract and be under a time frame, or it's month to month, but you'd pay something on the promise that they're going to move your score from 550 to 650 or something of that nature, whatever it was. And the problem is you honestly cannot make that promise. And the reason why is that some of that work has to be done by the individual. Well, as I just told Ebony on the phone, Jay, I don't mean this to be mean, but it's just the truth. The reason people have scores in the low 500s are probably the reason they're not going to take the necessary steps to get their score to 650 or 700. So, and Ebony's comment, a friend of real estate agent friend of Jay's, she made the comment, she says, Greg, the one thing that none of us can do, we have to change their mindset, and we can't do that. And she is right on target. We need a psychologist to help teach people how to change their mindset so they can move things up. Now, so if you can no longer just go to a company like I used to go to, Continental Credit, for improvement, then what do? Now, those companies are still going to exist. They're going to structure what they do very differently. The promises that are made are probably not any longer going to be promises. It's going to be something else because that's the only way that they can exist. So with that in mind, I want to take it now to the lender level, because I only refer to small percentage of my credit challenged people to Continental Credit. Everybody else I would try to work on myself to a point. If they had lots and lots of collection issues that needed time and effort and everything else, I would refer them over to Continental Credit, because Continental Credit will write all the letters. They'll do all of the things to follow in place to hope we get them removed and make changes and all of those things. And they used to do a great job of that, because I know the people won't do it themselves. And a lender does not have time for that. I do not have time to write letters for people. I do not have time to get on the phone with them and argue with the collection agency. That's just not what we do. So as a result of that, what are things that can be done? Well, first, let's look at thresholds. Most lenders today, not all, most lenders today do not do loans with credit scores below 600. Now, if you read FHA or VA guidelines, they'll say that there really is no minimum credit score. Some lenders, like we, say we won't go below 600. Others say 585. But go ahead.
What about the new rules of the 580?
What's that?
What about that 580?
Well, there are rules. I mean, but we're not. I mean, we don't go below 600. That's what they call a lender overlay.
Oh, so like your bank is
Correct.
Okay, yeah.
We're saying, I don't care what they'll take. We're not doing that. Okay? And you might ask, well, why would a lender do that? It's because risk. I mean, there is so much risk, because we could do everything right. We could do everything right. But if that loan has a default or a deficiency on it, that scores against us. And it doesn't take a rocket scientist to answer this question. What's the probability of somebody with a 580 credit score? What's the probability of them having a deficient payment or a default completely on the loan versus somebody with 700? Pretty big. So a lot of lenders will draw what we call an overlay, and we just don't go below there. That's fine. I mean, you do whatever lenders can do what they want. So anyway, so what I do want to talk about, though, is how do we, as a lender, potentially help somebody? What are the things that we can do? Now, if you speak to any lender, they will tell you that they have got a tool, and all of us have this crazy tool, that when we run a full-blown mortgage credit report, not one of these little soft pulls, a full-blown mortgage credit report, we get two credit scores. We get the actual credit score, and then we get a potential credit score. That potential credit score says, if you do certain things, you could move your score up to that. Every lender has that tool. And personally, and I'll say it to this thing while I'm being recorded and to all of you, that is a joke. Because there is no one who knows exactly how the outcome of that algorithm is going to be. So it says, if I take this debt and I pay this one down to here, I have the potential to move my score up to here. Do you think anybody ever hears the term potential? No, of course not. So they take that action and the score doesn't go up there, and they're wondering why. It's because the algorithm isn't looking at that one thing, it's looking at everything, and something else changed. And because that something else changed, the score didn't move to where they were potentially going to go. So I know, and there are some lenders that do it the way that I do it. We just be honest with people, completely transparent. There are some things you can do that are going to have that will, in fact, move your score up. How much it moves it up, don't know. There are a lot of factors in place. So what I did is I wrote down some things. You don't have to remember all these, just that you're aware of them. So as you're speaking with potential clients, people that you, and hey, look, talk to Greg, talk to whoever you trust, that can walk you through what you could do to get a score from 550 to 600 or from 700 to 750, because there are things you can do. So let's start with the first one. All right, the first one is no new credit. That sounds so elementary. It sounds so basic. Because what we're saying to someone is, don't go take out new credit if you're trying to buy a house. Don't go buy that car. But they're running all these specials at Memorial Day, and I want to get out there. If you apply for credit, your score is going to go down, period. If you take out new credit, it's going to drop significantly. Now, it won't stay there, but that's what's going to happen. So, live example. My wife and I. A few years ago, we were buying my wife a car, and we both have very, very high credit scores. And I said to Michelle, I said, why don't we just do the loan in your name? And actually, we were going to pay cash, but the heck, they gave us 0% back when they were doing 0%. We said, well, just take that, pay it off in a year. What difference does it make? And she said, okay, fine. Her credit score dropped 60 points. 60 points. And she's got perfect credit. So now, it took about 5 months, and the score was back up again. But that can happen, even with someone that's got perfect credit scores.
So why did you go 60 points?
What's that?
Just for her applying for it? Or?
No, she took out a new loan. She took out a new car loan.
No new credit.
She took out a new credit, a new installment loan on a car. Dropped at 60 points. And then over the next 4 months, it raised up each time she made a new payment. But if somebody's buying a house in the next 60 to 90 days, and they take out new credit, they're not going to get that 60-point bump back in that time frame. It's going to take longer than that. So the first thing is no new credit when you're going. That sounds so elementary, but I promise you, borrowers don't know that. Oh, I've got 797 credit scores. I can take advantage of the Memorial Day special. No, you can't. That's a problem. All right, the next thing is what I call the 29% threshold. You may have heard of it at the 30% threshold. Every revolving, not installment, every revolving line of credit has a high credit limit. Let's just assume it's $10,000. That means you can use that revolving line of credit, meaning typically a credit card. You can use it anywhere from $0 to $10,000. And honestly, if you go over the $10,000, they don't cut off your card or do anything of that nature. But if you read the fine print, interest rate goes up substantially, and there's penalties. And so you don't ever want to go over the high credit limit. The number of times I look at credit reports and I look at the high credit limit and the outstanding balance, and the outstanding balance is above the high credit limit. I see it all too frequently. And, well, I just made a payment. Well, I know you did. It hasn't shown up yet, which means that the algorithm has totally beat you up. And they said, well, how low should it be? I said, well, technically, to get the benefit of on-time payments, you want it below 29%. Give you an example. I'm doing business with a client right now, and the client is somebody that's a client of Century 21, and this person has absolutely perfect payment history. I mean, perfect payment history. And there's a fair amount of credit, and there's never been a late payment on this credit. Credit score is just under 680. There's never been a late payment. There's a house on there's been a house paid off, there's cars have been paid off, then Greg, why is it below 680? If you look at the report, first of all, there's 2 new lines of credit. There's a new car that was bought 3 months ago, and there's a new credit card that was taken out a month ago. Then you look at the other credit cards. There are no credit cards below 30%, the 29% threshold that I write down. None. There are several that approach the 100%. They're above 90%. So this person has absolutely perfect payment history, makes a tremendous amount of money, and the credit score is below 680. Now, I can easily get that score to 780. I can. They may not. They have to, there's nothing I can do about the car they bought 3 months ago. That's just going to be there. But if they take every one of those revolving lines of credit and they get it down to 29% before we pull another report, they're going to be up over 750. There is no question. Because they have so much perfect credit, but they've killed themselves.
So why don't they just pay it off?
They don't have the money to right now. They don't have the money to. They will once they sell their house. So, but that's the situation that they're in. So, the 29% threshold. You oftentimes hear lenders talk about 30. I always go to 29%. You want to be at 29% or less. And you never want it to go over 29%. Right? Camille? Right. Camille and I have had conversations about this for a few years. That's why we can have fun with it. But that's just the number you want it to be. You want it to be below 29%. All right, next. Collections. I'm going to make 2 points on collections. When a lender sees collections on a credit report, if those collections total over $2,000 on a government loan, then they don't have to pay them off, but we have to take 5% of the balance as though it is the monthly payment, not including medical.
What do you mean by that?
Okay, let's say that they've got collections on their credit report that total $4,000. All right? We have to make a pretend payment of 5% of the $4,000, which would be $200. And that becomes part of their debt to income ratio, that $200 payment. Even though they're not making it, that's just how the lending rules are.
So that's students and forbearance and stuff too, right?
What's that?
That's like students. So for example, that client you worked with, Sahi, who just got out of college but had this tremendous job, but loans don't start for a year down the road, but you have to go ahead and...
Well, in that case, we're not going to use 5%, we use 1/2 of 1%. Okay, big difference.
You still have to use
You still have to have a pretend payment, yes.
And
But-
that's just used for your qualification.
Yes.
It's not like you're going to pay that $200 to you.
No, you're not going to pay it. It's just we have to use it for qualification purposes. So we put that debt in there. All right? But somebody has a car repossession that happened 6 years ago. Car repossession is $13,000. That's a collection. $13,000 times 5%. That's $650. You put $650 of debt into most loans that I see, and they're not buying a house. So that's why it's so important that we look at collections and you know what that number is. Now, if it in a government loan, if it's less than $2,000, we don't add anything, which is nice. Conventional, the limit is $1,000. So conventional is going to be much more strict on collections than government loans. Most of the time when we see that, we're looking at government loans anyway. So we've got some flexibility, not all flexibility. Yep.
When you say less than $2,000, are you talking about loan balance or loan payment?
The collection.
Okay.
So let's say you have 4 collections, each one is under $500, and they total $1,600. Okay? We don't have to add anything to the DTI. We don't add anything as a payment because it's under the total amount of collections is under $2,000. All right? Again, you don't have to remember all this. The purpose of this is that when you're speaking to the lender and they tell you someone's got low credit scores, what do they have in collections? All you want to know is that they're not going to get burned. You just don't want your client to get burned. Now, a good lender, you don't have to worry about it. They know what they're looking at. They're taking care of it, taking all that into consideration. Sometimes they might have a balance on a collection of $300. And I'll tell the client, let's negotiate with them. Do you have $175 or $200? Yes. Okay, good. I want you to call the number. Here's the number. I want you to call them. They won't talk to me. I want you to call them. And I want you to negotiate. Tell them that you'll immediately send them a check for the $200. And they'll negotiate with you, so now they'll make it a zero balance. It's not coming off the report. When they report it next time, it's going to show zero balance. That thing shows zero balance, you're going to see a nice bump in the credit score. Yes?
So won't it say that you've agreed to pay less than the full balance?
Not necessarily, no. That's usually on installment loans, not terribly frequently on revolving debt.
No, I thought on credit card, like, so if I had $10,000 of debt, and I, like you said, I go with them, I'm like, hey, I have $2,000, let's negotiate right now. I was, on the credit report, I thought it says you agreed to pay, like, you paid off the balance, but less than the full amount.
Sometimes the creditor will do that. If you're paying off a collection agency, they'll never do it.
Oh,
Okay? So let's just say it's Capital One. Capital One may or may not make that comment. But if they sell that to a collection agency, the collection agency, they'll just collect the money and it's done. Okay? And the reason a collection agency is willing to take such a smaller amount is because they only paid 5 cents or 10 cents on the dollar. So if they can get 50 to 60 to 70 cents on the dollar, they're happy. All right? That's a big deal. Now, sometimes people are in collection and they're making monthly payments, and they've been making monthly payments for 6, 12, maybe even 18 months to pay down the debt. And then the mortgage company runs their credit report and we look at it and say, oh my gosh, it doesn't show that. Credit card companies, collection agencies, they do not report your on-time payments to pay off a collection. It's a non-reported item. So it cannot possibly help your credit score until it shows a zero balance. Late payments. If you have recent late payments, it kills you. It just...
So what happens if they do that payment is paid less? Does that still hurt your credit, or does it have the
No,
same effect?
not if it's a zero balance.
Okay.
It's fine. Okay. That's just a comment. It's not going to hurt. Recent late payments that are less than 12 months old are serious. Once you get to that 13th month, the algorithm will pick it up as, oh, okay, you've been managing your credit pretty good for the last 12 months, for a year. So you'll get a small bump, positive, but inside 12 months, you're in deep doo-doo, okay? So, Jay?
So question, is it better to use the cards and let under 29% report? Like, I use my cards, I don't pay interest on anything, so I pay them in full, so it never reports, so it just looks like nothing. But then some people are like, don't pay them off, keep a small balance.
Okay, which is the next thing on here.
Oh, okay.
All right, perfect. So here's what Jay is saying. Is it better to pay him off? Is it better to... First of all, if you're not in the mood to buy a car or a house, don't worry. It's not that big a deal if you go over 29 or 30%. All right, because in my case, my wife pays off every credit card. We only have a couple, but she pays them off every month, whatever they are. But when I was getting ready to buy the house that I bought in Alabama, when I got ready to buy that house, I made absolutely sure every balance was down below, which they are, below 30%. Because if they run the report, it doesn't make any difference, Jay, if I pay it off every month. If they run the report and my $10,000 high credit balance is showing $9,000 at the time, that means I'm at 90%. They don't know that I'm going to pay it off at the end of the month. All they know is that the current balance is 9, high credit is 10, 90% utilization, score goes down. All right, we've covered a lot of information. Thank you. Hope you got a few talking points for this next year weekly videos. Yes.